Let's go ahead and turn to page 213 in your text, which gives you a summary of merchandise entries for the merchandiser using the perpetual inventory system. We're going to focus on perpetual and not periodic throughout this class. So if we go ahead and look at the sales transactions, the first one, the selling merchandise to customers. For example, if a Walmart is selling to you, what they're going to do is they're going to debit cash or accounts receivable depending on how the transaction is paid for, and they're going to basically credit sales. Most likely it's going to be a cash transaction if you're using a credit card, but you get the point. Cash or accounts receivable is how they're going to receive that. That's their asset they're debiting, and they're going to go ahead and credit sales. At the same time, what they're going to do is they're going to debit cost of goods sold, this is a new entry on the income statement. It's an expense. It's basically their cost of that merchandise that they sold. And at the same time, they're going to credit merchandise inventory because now they sold it and they're basically getting rid of it, and that's going to reduce their balance sheet inventory amount. Now, at the same time, if the same customer returned merchandise over here, granting sales returns or allowances to customers, what we're going to do, or that company, Walmart or what have you, will debit sales returns and allowances, and they're going to credit cash or accounts receivable. And at the same time, they're going to debit merchandise inventory because that's coming back into inventory. And basically, it's just going to be a reversal of this journal entry on the return. So debit merchandise inventory, credit cost of goods sold. Basically, we're putting that back in the books. Now, paying freight costs on sales, FOB destination. Check out in your textbook the different examples of that and who pays what and when. Freight out is an expense account. That'll be debited, be placed on the income statement. Cash will be credited because we're paying out cash. We're reducing that asset. Receiving payment from customers within cash discount. What we're going to do is we're going to debit cash. We're receiving cash. We're going to debit a contra account called sales discounts, and we're going to go ahead and credit accounts receivable since we're basically reducing that asset. They no longer owe that to us anymore. Now, if we go to purchase transactions, the purchase transactions are basically Walmart buying from their wholesaler. So, an example would be purchasing merchandise for resale. They're gonna go ahead and debit merchandise inventory, credit cash or accounts payable, and this is kind of the same thing that we went through in exercise 5.2 in this week's homework. If they pay freight costs on merchandise, FOB shipping point, then I go ahead and debit the merchandise inventory and credit cash. Receiving purchase returns or allowances from suppliers, basically get their money back, or they're going to reduce their liability. They no longer owe their wholesaler this because they're actually returning it, and they can actually credit merchandise inventory. Paying suppliers within discount period. Debit accounts receivable, no longer owe that liability anymore. We're getting that off the books. Crediting inventory and crediting cash. And down here is basically just adjusting and closing entry. Is basically the same thing in the previous chapters, previous week. Adjust because the book amount is higher than the inventory amount. So basically, that's if you take your physical inventory and you see that, hey, I have less inventory than I should have. We're going to debit cost of goods sold and credit inventory. Closing temporary accounts with the credit balances, which is sales. You're going to debit sales to close it out to income summary, where we credit income summary. So debit to sales, credit to income summary. Closing temporary accounts with debit balances. It's going to be just a reversal. And doing a debit inventory, income summary, and credit the following down here. And the difference between this and this will obviously be net income or net loss. So if you have your T account with income summary, the revenues will be on one side, the expenses will be on the other side, and that net difference in that T account will either be your gain or profit or your loss. So this is actually a good example, and this is page 213, and you can definitely refer to this in your homework for your homework examples.